of Mr. Prabhakar Rao garu. So it is very nice that we are meeting again in IACC's webinar. And when Ms. Shikha Sabharwal requested me for doing one topic on webinar again after my earlier webinar of foreign collaborations and technology transfers. So then she pursued, and it's very nice that we are again meeting, and it is always a good memory doing a webinar with Indo-American Chamber. And as far as the overseas investment is concerned, we have been hearing more about foreign direct investments into the country in various forums, and there is much discussion about the foreign direct investment, but the trend is slowly changing, and it is the outbound investment is picking up over a period of time, and slowly it is spread to many countries, and also the amount of investments also have outbound investments have increased. So we have given those details at the end of our session. But the only question is, there are delays in clearances. There are restrictions on certain areas. These are some of the issues which we have discussed in this paper. So I introduce my co-author, Mr. Bhargava Naidu, who has helped me in doing this entire webinar, and also Mr. Hemant Bejadu. And Bhargava Naidu is the chartered accountant and partner of our firm. So now this paper is based on RBI circulars of 2010-2022 and FEMA notification of 2022, Ministry of Finance notification also. These are the things which we have taken as basis for preparing this paper. So as far as introduction is concerned, I have already told what is the overseas investment and how we have been increasing there is growth in investment outside the country. So the various basis circulars, the circulars which we have taken as basis, they have first given the definitions first, because there are number of definitions which we have been seeing, and for this particular purpose, certain definitions are clarified by RBI, and they are important to understand the total policy framework and all that. So one of the definitions that RBI has clarified is joint venture. Joint venture is a joint venture between an Indian entity and a foreign entity, and this foreign entity should be registered and incorporated according to the laws of the host country. Then the Indian party makes the investment. That is the joint venture, unlike our joint ventures here. So then wholly owned subsidiary. Wholly owned subsidiary is it is again registered, incorporated according to the laws of the host country, and the entire capital is held by the Indian party. That is the requirement. The control here, though control is defined in various laws, or like company law and other laws. Here it is clearly defines that it is the right to appoint the majority of the directors. So, who are the management personnel who take the policy decisions, directly or indirectly. That is the meaning of control here. Then sometimes it is also based on the shareholders' agreements and management rights, etc. Another important definition is Indian party. So who is the Indian party? There are a number of Indian parties which are a number of business organizations, but which are the parties that are eligible to invest. One is the company incorporated in India, then body corporate created under an act of parliament. That is, some of the publicity undertakings, some of the business undertakings are created by an act of parliament. So that is another one. Then partnership firms registered under Indian Partnership Act, and also limited liability partnership firms. These are the parties which are eligible. But where they can invest? They can invest in bona fide business activities. So what is bona fide? Is it should be bona fide in both the countries. It should be though every business activity is a legitimate and lawful activity in any, but in both the countries it should be permitted. There are certain countries which may not allow certain activities to take place, whereas the purpose of this is bona fide business activity should be bona fide as per the laws of that particular country, and both the countries should allow. That is the bona fide activity. Next comes overseas direct investment. See here, the OI is overseas investments. What is overseas investment is? One is the direct investment, which you can directly invest in the company's equity issues and participate in their business activity. Whereas the OPI, that is overseas portfolio investment. Portfolio investment is acquisition of the equity in the market. Anything other than ODI is OPI. That is the portfolio investment. So there are two modes of investment. One is the direct investment, and the other one is portfolio investment. So the peculiarity about this particular OI, or speciality about the OI and the OI framework, it includes equity as well as debt. Normally, debt is not considered as equity, but here debt is also considered as equity for the purpose of outbound investment. So what is the equity? Equity includes unlisted equity, subscriptions to memorandum of association of foreign entity, investments in 10% or more of the paid up capital of the listed company, and investment in listed company with control, but less than 10% of the paid up capital. Here, the emphasis is investments in 10% or more of the paid up capital is, that means at least 10% should be your investment. Then in the case of where control is required, it can be less. That is even if it is less than 10% also, but control must be exercise. So control is important. Here the emphasis is more on control rather than the we holding more equity. Character of ODI does not change even if the control is lost or falls below 10%. That is the clarification given by Reserve Bank of India. The equity capital means non-debt and irredeemable compulsorily convertible instruments. That means, when we see in companies both equity as well as debt, that is debentures, for example. So in such cases, they should be irredeemable and they should be compulsorily convertible. So you cannot keep a debt instrument as debt instrument. A debt instrument has to be ultimately converted as equity. That condition is very important. So what are these investments? That is all investments in equity in incorporated entities. That is public, private, listed and unlisted companies. Then capital participation and limited liability partnership firms. All instruments of investment as recognized in the foreign direct investment policy from time to time, FDI policy. Then investment in units of alternate investment funds and real estate investment trusts and infrastructure investment trusts. You may find a contradictory point at a later slide that is about the real estate. The real estate is a negative sector for the purpose of overseas investment, but real estate investment trusts are allowed. So the investment in units of real estate investment trusts are allowed. Investment in units of mutual funds and exchange traded funds for which invest more than 50% in equity. They are also considered as equity capital. Then in any securitization structure, the equity tranche is treated as equity capital. Then acquisition, sale, or dealing directly in immovable property. That is also treated as investment because many people, many Indians, they invest in land and buildings. So immovable property here should be again, should not be mistaken as real estate. Immovable property is suppose an industry is being set up. It requires land and buildings. So that is also an investment. So specifically that is given that freedom to invest in immovable property. That is the specialty about this. The contribution to trusts, then depository receipts issued against the equity instruments. These are all called equity capital. Then what are the debt instruments? Debt instruments are, they include government bonds, corporate bonds, all tranches of securitization structure which are not equity tranche. That is, any debt instruments are allowed in this. Borrowings by firms through loans. So the Indian party can always borrow and invest. So this is also treated as a debt. Depository receipts whose underlying securities are debt securities. This is another. Then when it comes to equity and debt, it is off. There are certain restrictions also on investing in the overseas companies or overseas organizations. The first thing, as I already explained, real estate, including transferable development rights, there is a restriction, and this is a negative activity as far as investment is concerned. Then gambling in any form, gambling, lotteries and racing and whatever types of gambling, they are all negative activities. They're dealing with financial products linked to Indian rupee without specific approval from RBI. That means RBI's approval is required for the purpose of dealing with the financial products, whether it's a derivative or whatever other financial products are concerned. The overseas portfolio. So overseas direct investment we have discussed, and whatever other thing we have to now think is portfolio investment. What is portfolio? Always portfolio means acquiring it in the market. So here it is other than ODI, you are acquiring it in the market. So that is portfolio investment. So this includes acquisition by rights issue and bonus issue. Why rights issue and bonus issue are specifically mentioned is because any rights issue or bonus issue is basically a right of the shareholder who is already holding the equity. So automatically he gets it, but only thing is there is no specific financial commitment, like which we'll discuss later in the later slide. So that's the reason why it is called portfolio investment. Then capitalization of account due from foreign entity. So any capitalization of any the accounts, that is, say for example, any amounts that are due by virtue of the services made by the Indian party, and which are remaining as a debt and which are not received. So such things are all they are treated as capital thing, and they whatever is the due from a foreign entity, and in case you are capitalizing and converting it into equity. See here, capitalization is nothing but converting any amounts due from the foreign entities. So once that is treated as equity, then that is also portfolio investment. Then swap of securities. Then there are also acquisition in mergers, demergers, and amalgamations. So there are acquisitions because by virtue of a court order or a tribunal order, so we are merging two entities. In such cases also, equities are acquired. So that's why it is called portfolio investment. Then what are there any restrictions on OPI portfolio investment? Yes, there are. That is unlisted debt instruments. So all debt instruments, whatever debt instruments we have discussed earlier, they all should be listed. If they are unlisted, there is no eligibility for investment. So you cannot invest in unlisted debt instruments. The next one comes securities issued by a person resident in India who is not in an IFSC. So any security issued by a resident in India, IFSC is an international financial service center. So if any security is issued by such organization, there cannot be any OPI. The derivatives not permitted by RBI. RBI special approval is required for any specific derivatives. Suppose you would like to subscribe. So in case there is no RBI permission. So such derivatives you cannot invest. Then commodities, including bullion depository receipts. The commodities also, you cannot invest in commodity or commodity exchange because because it creates speculation, because it's a speculative activity, and also it is a it creates inflation in various countries by our investing in commodities. So, and similarly, bullion depository receipts also. That is the idea behind it. So, why commodities are not allowed? Yeah. OPI can be made by a person resident in India. So here we should also understand resident in India can be an individual or an entity. These two are treated as residents, but you cannot treat this resident in India as per Income Tax Act. You should treat this as per the FEMA. So for Foreign Exchange Management Act. So anybody who is residing in India way back in 1946 is treated as a resident as far as FEMA is concerned. In the month of July, in 1946, then he is treated as a resident. Okay, many people may not be alive now. So equity capital listed even after it is delisted, it can be treated as OPI. So even though equity capital is listed and afterwards it opts for delisting, then still the equity that is originally contributed is treated as OPI only. Then a listed Indian company may make OPI as investment or reinvestment. That means in the portfolio investment, whatever investment that we make, we may sell also, and then again we can reinvest also. So that is the idea behind the investment or reinvestment. So both are treated as portfolio investments. An unlisted Indian entity incorporated in any law like society, partnership, and trust, etc. These are the areas where OPI can be made. What are the other what are the investments that are considered? Where we can invest, we have mentioned. Then which are the investments that are considered as OPI? That is opening up demat accounts by clearing corporations, corporate stock exchanges, and clearing members. And OPI may acquire, hold, transfer foreign securities offered as collateral by investors as per SEBI guidelines here. So SEBI is permission, whatever is permitted by SEBI, only such foreign securities can be acquired. And open and maintain demat account with foreign depositories. This is also like Indian depositories, we have foreign depositories in such cases, because we have already mentioned the first point, that is opening demat account by clearing corporations. So similarly, opening a demat account in foreign depositories. Then remit the proceeds. So any sale proceeds that are remitted back, they are also treated as OPI. So these are some of the things. Continuing the list of investments, liquidating the foreign entity and repatriating the proceeds to India. So any proceeds that are repatriated to India after an entity is dissolved or an entity is liquidated, in such cases also it is treated as OPI because we are getting back our money. But still, though it is inbound money, but still it is treated as OPI. Acquisition and transfer of foreign securities by domestic depositories, and where the underlying security to issue Indian depository receipts as per FEMA regulations. So any foreign securities by a domestic depository where the underlying security to issue is as per FEMA guidelines. Then acquisition and transfer of security by the AD bank, including its foreign branch in the normal course of banking business. In banks, well, not only in India, in other countries also, one of the activities of bank is investments. So in the course of the normal banking business, the surplus funds are always invested in investments. So such investments, whenever a bank, whether it is in India or foreign branch, in the normal course, if it is uh, transferring such securities, and those transfers and the sale proceeds are also treated as OPI. OPI by mutual funds, venture capital funds, alternate investment funds acquire or transfer of foreign securities as stipulated by SEBI from time to time, and limits prescribed by RBI and individual limits by SEBI. See, limits prescribed by RBI are the overall limits by an individual, that is, which we have discussed later. But I can tell you it is $250,000 per annum by an individual, and all these things are require require SEBI's whatever is approved by SEBI only they can invest. There's OI IFSC by person resident in India, overseas investment in IFSC. What is IFSC? IFSC is a International Financial Security Center. So what is this International Financial Security Center is? So it is an activity it's a financial services activity, and which IFC, which service centers are eligible for such OI are they must be existing at least 3 years before this particular investment is made, and there must be a track record of profit in the preceding 3 years, and it should be registered with the financial regulator in this country, and sometimes it may be required in that country also, depending on the host country's regulations. So that is where the OI is required, and the approval by financial regulator, when I mentioned, it is required within 45 days of the investment. That is one thing. And non-financial Indian entities can also invest even without meeting the net profit conditions. What are the non-financial Indian entities? They exclude both banking and insurance sectors. Other than banking and insurance, other non-financial Indian entities can invest. Then OPI is allowed by contributing to investment funds and SPVs. This is another area that is included. ODI can be made in financial service entities having subsidiaries or step-down subsidiaries outside IFSC, whose control is held from here. So that is both subsidiary as well as step-down subsidiary. Both subsidiaries and step-down subsidiaries should be registered in the foreign countries. Then ODI in startups. Even in startups, the ODIs are allowed. So startups are defined as per our law. Similarly, ODI, whatever startup is there, they can be invested, but only restriction is they cannot be invested with borrowed funds. It should be out of the funds that are accumulated out of the activities of the investor, and out of their net profits and reserves only it can be invested. So borrowed funds are not allowed. That is the one thing. And a certificate from the statutory auditor or as chartered accountant to this effect should be submitted to the bank when authorized dealer bank when it is being submitted. So Indian entity can open and maintain foreign currency account for the purpose of making ODI. Either you can transfer the monies from here or you can open a foreign currency account in the host country for the purpose of making ODI. Then investment by resident individuals. As we have already discussed, that the resident individuals as well as the entities can invest in the direct investments. So in this, the overall ceiling limit is as per the liberalized remittance scheme, and liberalized remittance scheme fixes this as 2.5 lakh dollars per annum. That is the but here we should not mistake liberalized remittance scheme and here only it is only meant for the purpose of the limit that we are using the word LRS, but otherwise LRS has a separate purpose because any remittances that we are making under LRS are only meant for education, travel, health, and certain requirements. Whereas here we are using that LRS limit only for the purpose of this particular investment. So operating foreign equity with the exception of financial activity, which requires registration by the regulator. So investment can be made by resident individuals. Only thing is in financial activity, wherever any financial activity, it should be registered with the regulator. Regulator that can be RBI here or any other regulator in the other country, host country. Then operating foreign entity should not have subsidiaries or step-down subsidiaries where the resident individual has a hold. See, operating a foreign entity, that means, as we have already discussed, the foreign entity is specially registered in the host country, and that is where we are making investment. Or an existing foreign entity also we are making investments. But in such cases, it should not have a subsidiary or a step-down subsidiary. Subsidiary, we have already defined what is subsidiary, and now it is step-down subsidiary. The subsidiary itself starts another subsidiary, then that is called step-down subsidiary, but in these things, the resident individual should not have a hold. Then OPA can be reinvestment, as we have already discussed what is reinvestment. Then capitalization of amounts due from foreign entity, this is also we have discussed already. This doesn't require any prior permission. Capitalization of any amounts due from foreign entity, because we are instead of locking up our monies abroad, that is coming as equity for the Indian party. Then swap of securities on merger, demerger, amalgamations, and liquidations. So these are some of the investments that are allowed by the resident individuals. Then sweat equity shares. Sweat equity shares under ESOP. ESOPs for any employees, they are also treated as investments. The acquisition of minimum qualification or holding for the management post, depending on the host country's regulations. In case management requires any qualification shares, then anything that is acquired for the purpose of management post, that is also treated as investment. Acquisition through rights issue or bonus issue. Rights issue or bonus issue are actually attached to the main uh, the shareholders' right. So it is also treated as an investment. Gift or inheritance without any limit from a person. So this is one thing where the limits are also not applied. Limits are not applicable because an inheritance, nobody knows what is the amount of inheritance that you get, and similarly gift also, it is out of love and affection somebody gives gift, so the limits are not applicable here, and any amount of money that that is received is treated as investment. Investment mentioned in item number 4 to 7 above cannot exceed the 10% of the paid up capital of the foreign entity, uh, because the purpose is it should not lead to control. That is the idea. So then investment by registered trusts and societies. So registered trusts and societies, they are as I have already explained this, they should what is a registered trust and society, and it is existing where you can invest in such societies or trusts. It should be existing at least for 3 years before investment. It is engaged in the same sector that is in investing society is engaged in. That means, suppose the society is in a health sector here, so it can again this trust or society can invest again in health sector only, not in any other sectors. So that is one thing. The constitution of the trust or society should permit such overseas direct investments. See, the objects clause of such a trust or society must allow, and governing body, either it is a general body or the governing body, should approve such investment. Then AD bank shall satisfy itself that the special permission or license, if any required, is obtained. That means in certain cases, under any other law also, in case any special permission is required, that is like we take Home Ministry's permission in case of any foreign contributions coming into India. Similarly, other host countries also may have some special permissions. So permission for making overseas investment. This, as we have already discussed various things. Now permission, it is coming to the permission level. So permission is there is automatic route and there is approval route. So what is automatic route and what is approval route? A person resident in India can make a transfer of any investment of financial investment under automatic route as per general permission as per OI rules and regulations in a bona fide business activity. So RBI and Finance Ministry allows certain activities as bona fide activities. So in such cases, the overall limits, what are the overall limits? The overall limits for individuals, it is 2.5 lakhs per annum, whereas for the purpose of business entities, it is 400% of the net worth of the business entity. So that is though that is coming at a later slide. So then meaning of financial commitment and Form FC. See, for anybody who wants to invest, he abroad, he has to file Form FC. FC is not foreign collaboration. FC is financial commitment. So if the commitment has to be very clearly mentioned whether it is the financial commitment is in equity, whether it is in preference shares, whether it is loans, whether fund-based or non-fund-based, then corporate guarantees and bank guarantees and performance guarantees also. In case of performance guarantees, only 50% is allowed, rest are all 100%. Indian party can extend loan or guarantees to overseas entity only if there is already an existing equity or convertible preference shares by way of direct investment. However, the RBI's approval is obtained, the Indian party may undertake such financial commitment without equity contribution in joint ventures and wholly owned subsidiaries based on the business and legal requirements of the host country. Then when we have come to the limits, what are the limits that you can follow for the purpose of investment? So here, the resident individual, as already told, 2,50,000, 2,50,000 per financial year. Indian entity up to 50% of the net worth in OPI. ODI, you can go up to 400%. Then OPI in IFSC is also another thing, that is 50% of the net worth. So ODI is 2,50,000, OPI is 50% of the net worth, and OPI and IFSC is as per the conditions laid down in Schedule 5 of the OI rules. ODI in equity and joint ventures is up to 400% of the net worth, as we have already discussed. Then debt funding. Debt funding is, as already mentioned, that is the specialty of this. Debt funding is also treated as equity. So this is also, it can go up to 400% of the net worth. So then corporate guarantees, 100% of the guarantee, and performance guarantee is 50%. These are all put together. They are included in that 400% overall limit. So whether you give a corporate guarantee, whether you you can give performance guarantee, corporate guarantee, and other all put together, the limit is 400% of the net worth. So then comes permission under the approval route. What is this permission under the approval route? In the normal course, when automatic route, you are following the RBI's requirement and accordingly you are remitting the funds. Whereas in the case of approval route, you have to make an application to authorized dealer bank, and it forwards the application after its scrutiny to RBI, and RBI will give the permission for such investments. For the purpose of this application, the background of the investment transaction and details are to be mentioned, reasons for seeking such approval, and you have to and the ID bank will add its own observations and recommendations. And for the purpose of ID bank to take a decision, there must be a board resolution or the management decision by a general body meeting, as the case may be. Then the various other things like valuation certificate for foreign entity and any other relevant documents that are required by the approving authority. These are the things which are to be attached along with that application for the purpose of approval. Then there are also approval from central governments required. Where central government's approval is required is in strategic sectors. Strategic sector is already defined as in these guidelines. That is energy sector, natural resources sector, and submarine cable system. This is recently added, that submarine cable system. Then in specific geographies. That means there are certain countries which are not treated as friendly countries. In such cases, those specific geographies also applications are to be forwarded to central government, and on case-to-case basis, after after seeing, after scrutinizing, then central government may give the permission. This also includes Pakistan. Pakistan is specially mentioned in these circulars, though in no other FEMA circular Pakistan is mentioned, but this particular thing, Pakistan is also mentioned specifically by. So then, so what is strategic sectors? The strategic sector, as I already told you, this is energy, natural resources, nuclear sector, and then defense related sectors and other sensitive sectors. The sensitive sector only includes that submarine cable system. Like that, the government may add from time to time these sectors where they are treated as strategic sectors. Then comes prior approval from RBI, financial commitment exceeding $1 billion. In such cases, a prior permission of RBI is required, and such limit is applicable for each financial year. So then NOC from the lender bank. So in case any applicant who is going for approval is treated as a NPA, non-performing asset, by the banker, or is classified as willful defaulter, or is under investigation by a regulator or investigating agency. In such cases, NOC is required from the lender bank. But there are also cases where, the NOC is specifically not, is given exemption. That is, in case the Indian entity is giving 100% guarantee under FEMA, in such case, because there is another Indian entity that is giving 100% guarantee. In such cases, the this NOC is not required, and NOC should be given within 60 days of the application. Otherwise, it is presumed that there is no objection. Then comes the rights and bonus shares. Rights and bonus shares. Person resident in India holding equity has a right, as already, wherever there is an issue of rights issue, there is a right for the shareholder. And similarly, whenever there is a bonus issue, there is a right for the shareholder. In such cases, what is the requirement of reporting? Because there is also reporting requirement, because the statistical information is kept by the government as well as the Reserve Bank of India. In case the right is exercised, you have to report in Form FC. The right is renounced, there is no reporting requirement. Then in case there is any bonus share, because there is a financial commitment, fresh financial commitment, so report is required in the form number FC. In case there is no financial commitment, there is no requirement of reporting. These are the various requirements up to the foreign direct investment and foreign portfolio investments are concerned. Now, Mr. Bhargava Naidu will take over the rest of the presentation. I can see it now. Okay. Now, Mr. Bhargava Naidu will take over the.
Yes. Thank you, Prasad sir, for giving us the basic understanding of the overseas investment. Overseas investment consists of ODIs, OPIs, and also we have seen the definitions, important definitions required. for understanding of these regulations, rules, and directions of overseas investment. So then, in the meanwhile, we have also gone through the definition of the financial commitment. And in the financial commitment, we have seen that it can be through the equity, it can be through the debt, as well as there are certain other points which have been included in the financial commitment, which is the guarantees, that is bank performance guarantees. Also, the financial commitment can also be made through pledge of shares. So we'll go in the next slides. The financial commitment by way of foreign entity through bidding or tendering process. So what is this bidding and tendering process? Whenever an Indian entity is willing to participate in a bid or tender of acquiring any foreign entity, we can do the same by approaching the AD category bank and intimating them regarding our interest of participation in the tender, wherein the AD category bank will support the Indian entities by giving a bid bond guarantee or an EMD required for participation in the bid or tender. This will not be treated as investment at the time of bid or tender. And once the bid or tender is done on the result of either successful or unsuccessful, if it is successful, it will be treated as an investment in the foreign entity, and all the reporting requirements of filing with the AD category bank, that is Form FC, need to be filed. If in case the bid is unsuccessful, the funds which have been given as an EMD shall be repatriated within the timelines that have been given in the Act. Next, moving on to the acquisition by deferred payment. Also, the residents in India, the person resident in India is being given with an opportunity of making a deferred payment. So deferred payment is something wherein you can make a payment in tranches, for example, whenever an Indian entity would like to acquire a foreign entity, the conditions of the agreement can be that in the first installment, the payment will be 70% on meeting certain requirements of achieving the profitability by the foreign entity. We would be making 30%, or as per the subscription to MOA, it can be that 70% in the initial tranche. After 1 year, the remaining tranche will be made. In that cases, the deferred payment option will be available for the Indian entities to opt for. And this whatever the amounts that need to be paid in the installments will be treated as a financial commitment and will be reckoned for the computation of this 400% of the net worth for the entities. However, initially, after making the first installment, the remaining amount will be treated as a non-fund based financial commitment. Later on, when the payments are made, that will be treated as a financial commitment. And also, the pricing guidelines, whatever is given in the overseas investment rules, are to be followed at the time of initial payment itself. So this is all about the deferred payment option that is available for the Indian entities while making overseas investment. Now coming on to the pricing guidelines. So this pricing guidelines is all about at what price the Indian entity would invest in a foreign entity. The regulations are given the banks to frame a policy, and it has indicated that the valuation is not required at the time of in two instances where the price is already available in the stock market. That is, if the price is already available in the international stock exchange, that is the fair market value, and we need not get the valuation done for the share of a foreign entity. As well as when there is a case of merger, amalgamation, demerger, liquidation, which is already approved by the court or tribunal, there need not be an evaluation done for the making of investments, because this plan of merger or amalgamation would already been approved by the court, wherein the share exchange ratio is fixed itself in the tribunal order. So there need not be a duplicacy of the valuation, hence that is being exempted. So for the remaining things like investment in JV or wholly owned subsidiary or obtaining stake in other foreign entities, the valuation has to be done. And so who can value the shares of the Indian entity? It can be a chartered accountant or the merchant banker. In the previous circulars or guidelines, only the merchant banker was allowed to perform the valuation. However, now from from 2022 overseas investment rules, even a chartered accountant is eligible for performing the valuation of the foreign entities. It can be United States or any other country. Yeah. So what is the methodology that the merchant banker or a chartered accountant can use? The methodology that they can use is the discounted cash flow or net asset method. That shall be internationally accepted methodologies. And now coming on to since the valuation is being done, at what value we shall can an Indian entity invest in a foreign entity? It should not be more than the fair market value arrived in the valuation. So this is all about the pricing guidelines. In case of a bidder tender, there is no point of getting the valuation done. And also valuation is not required for the overseas portfolio investment because they are the investments which are made in the stock exchanges. Now coming on to the transfer or liquidation, or we can say disinvestment. A person resident in India may transfer the equity of a foreign entity to either to an eligible resident person or a person resident of India. If the Indian entity is making or the person resident in India making the transferee is an Indian, then we have to check for the conditions whether he is eligible for making overseas investment or not. In case of person resident of India, there is no requirement. So generally the transfers are made in the cases of merger, amalgamation, buyback, and liquidation of the cases. So in such cases, we have to obtain the approval from the RBI as well as the regulations of the host country need to be followed. However, certain few transactions are exempted from it, wherein the entities which are getting merged are both the foreign entities which are getting merged are wholly one subsidiary of an Indian entity. The stake of the Indian entity is not going to change much. Hence, there is no requirement of approval from the RBI. Even in case of an amalgamation, if the acquiring company is the wholly owned subsidiary of the Indian entity, there is no requirement of the approval from the RBI in this instance. And in case of the liquidation also, there will be a change in the stake of the Indian entity. Hence, this need to be approved and Form FC need to be filed with the AD category bank. Now moving on to the restructuring. So when Indian entity, any person resident in India invests in foreign entities, there is always not a possibility of getting profits. So there can be losses due to in the course of the business. So whether the restructuring can be done or not, yes, the restructuring can be done by foreign entity on the approval of the Indian entity, provided the diminution in the value is more than $10 million. Also, there is a requirement of getting getting the foreign entity valued by the registered value as per the Companies Act when there is diminution is more than 20% of the investment. So by this way, even the restructuring can be done. See, in this case, in case of the restructuring or in the previous discussed point, in the transfer, there is always some change in the investment. Hence, this need to be reported as per the reporting requirements of overseas investment rules. So next, what are the reporting requirements? So we have seen overseas direct investment, overseas portfolio investments, as well as the financial commitment by way of transfer, and by way of financial commitment by way of bid or tenders. So these are all required to be reported to the RBI through AD category bank. So in case of overseas direct investment, it has to be reported in the Form FC. FC has got A to G parts, and the overseas direct investments shall also be reported by way of filing an annual performance report and FLA return. APR has to be certified by the statutory auditor of the company or the Indian entity, as well as whenever there is a transfer or acquisition of new stake, it has to be reported through Form FC. So what if there is a delay in reporting requirements? So if there is a delay in reporting requirements, the late submission fee, there is a scheme floated in the overseas investment rules that this delay can be made good within 3 years, 3 years from the date of delay, with the applicable penalties that are being given in the overseas investment rules. So the maximum penalty won't exceed the investment that is made into the foreign entity. In case of overseas portfolio investments, there is no if there is no requirement for the resident individual. However, if the OPI is made by the the overseas portfolio investment is made by the Indian entity, then it has to be reported semi-annually within 30 days from end of the half year. They are the requirements, reporting requirements under the overseas investment rules for the ODI, OPI, as well as for the financial commitments made through debt or through acquisition of shares or transfer of shares. There are certain restrictions and prohibitions. The prohibitions are already discussed by Sir in the previous slides. In the ODI in startups can be made only from own funds is also been discussed. Resident individuals are not permitted to transfer overseas investment. The Indian entity shall not lend directly to overseas step-down subsidiary. That is, Indian entity can give debt or give funds to the foreign entity, but not a step-down subsidiary. And also, a resident individual shall not make any financial commitment by way of debt. That means a resident individual can have an equity, but not debt. So, because the government does not want the resident individual to get exposed to the risk of debt, as there won't be any control in their hands. This is already we have discussed that 400% of the net worth as per the last audited balance sheet is the financial commitment that any Indian entity can make in the foreign entities. Again, this financial commitment is important definition out of all for the overseas investment rules, because that is the main cap for equity as well as debt, as well as portfolio investments. Now, guarantees. So we have seen the equity debt, and through transfer or demerger, the financial commitment is also made through guarantees. So guarantees. So when does an Indian entity require to give a guarantee, either for the support in the form of for the credit support or the operational support? Whenever there is a requirement of credit for the foreign entity, the Indian entities can give a corporate guarantee, as well as whenever there is an operational support required for the foreign entity to do its business in the natural course of business, then it can give the performance guarantees to the foreign entities. So these guarantees are also treated as financial commitments. The performance guarantee, for the purpose of financial commitment, performance guarantee will be reckoned as 50% of the amount given. Whereas in case of corporate guarantees, it will be 100%, and it need to be within the financial commitment. Also, the guarantees shall not be, the time limit has to be fixed for the guarantees. The guarantees cannot be given for an unlimited period. So, along with the Indian entities, the holding company and subsidiary company of the Indian entity can also extend the guarantees. Also, the individual promoter can also extend the guarantees to the foreign entity. When an individual promoter is giving guarantee to the foreign entity, it will be treated as financial commitment of the Indian entity. So this is another way of like having investment in overseas through guarantees. This is for the support of making support to the foreign entity to run its business. So pledge, charge, and hypothecation. So the Indian entity can pledge the shares of the foreign entity, as well as charge the assets of the foreign entities, as well as the Indian entities. So whenever in case of pledge of shares of an Indian entity of foreign entity in the favor of any bank, authorized dealer, or financial institution, or overseas lender, if the loan is taken for the purpose of Indian entity, it won't be treated as any financial commitment or overseas investment. However, if it is for the purpose of the foreign entity, that will be treated as a financial commitment. The same goes in case of charge of the assets of the foreign entity. If it is it can be favor of overseas lender, or the authorized dealer, or the financial institution in India. If the loan is taken for the purpose of IE, that is Indian entity, it won't be reckoned as reckoned under for the financial commitment 400% of the net worth. Whereas if it is for the foreign entity purpose, it has to be. And all these things need to be reported again in the form FC, as this. If in case the foreign entity is not meeting to the conditions, the shares there would be a change in transfer of transfer of shares from one hand to another hand. Hence, then same need to be reported under Form FC. Again, the section G of the Form FC is regarding the pledge of shares. So there are certain obligations of person resident in India. So before making any investment, the person resident in India, either entity or the individual, has to get the UIN number. This can be obtained through the AD category bank, and any evidence of investment has to be made within 6 months. 6 months. And as we have seen, as we have discussed in the prior, sending of remitting of EMD amount. In such cases, if there is an unsuccessful bid or tender, the amounts are to be repatriated to India. So any funds that are being sent, that has to be repatriated in case of in case there is no investment to the foreign entities. So with this, we have covered the complete overseas investment rules and the financial commitment definitions, as well as what does the financial commitment comprises of, and the 400%, what are the things to be reckoned. Now, Prasad sir will give the conclusion on this topic. I request Prasad sir to give conclusion.
Thank you, Bhargava. The overall layout, overall plan, the policy framework of the overseas investments is broadly discussed with the reference to the FEMA as well as RBI circulars. The purpose of, as I have already mentioned, that the foreign investment, the trend of investment abroad is growing. So the idea is, originally when Indians were doing some trade or any other dealings with foreign countries, it was mainly for the purpose of exports from India to other countries. Whereas we are now seeing the opportunity of investments and setting up of industries abroad, and also acquisition of companies abroad. The existing companies are also Indian companies are acquiring, and this is a very good trend. That means the Indian business community has got confidence to grow abroad also. And at this rate, with our technical manpower, because we have got the largest technical manpower in the world, and also our GDP rate is the higher than most of the countries, and we are one of the most developing nations in the world. With all these features, we may one day take over many business entities, or we may control some of the business, the business environment. We may lead and we may even control. That's what is the trend now. So the trend, if you really see, as per the RBI statistics, the foreign investment by India in the last 4 years, that is 2021 to 23-24, is 4.63 lakhs, whereas direct investment is total is 13.78 lakh crores. So still there is, we are on the negative side only. It is not the positive side that we are investing more, but still we are receiving at the receiving end only. But the trend is from 2021, 0.81 lakh crores to 1.38 lakh crores in 23-24. That is what is a good trend. And also we have seen in the recent past, that is Tata Communications, then Jindal Constructions. These are all the major companies in the country. They are starting their own subsidiaries, foreign subsidiaries. So this is a good trend. So this will continue, and with the technical skills, and also we have mastered our own technologies also. Not only that, we have developed our own technologies now in many areas, including space, so, and the aerospace and all that. So we can there is a lot of scope for us to play an important role in investment as well as development of many developing nations. If you see the slide that is coming, even in US, our investment, our out of our total investment, US investment is coming to 14% of the total investment. So it is not earlier. It used to be mostly in countries like Singapore, Mauritius. So if you really see the next page slide, though we have come now. So Singapore, we have got a 20 out of our total investment, 20% of investment has gone to Singapore, 14% has gone to Mauritius, 12% has gone to USA. So, and other countries like Netherlands, then UK and UAE, these are, and Russia also. And these are some of the countries where the investments are going. And in the recent past, there is also a trend of investment in Sri Lanka and Cyprus. These are some of the things that we should notice. Then so the country-wise distribution we have already given, and the financial hubs like UK, UAE, Switzerland, Channel Islands, Cyprus, they are attracting a lot of Indian investment. Then ODA is also diversified into many other countries like Sri Lanka and Mozambique, as I told. Overall data underlines India is rising its global footprint. The overseas investment rules also are slowly being liberalized. The framework supports greater Indian participation in global value chains, especially where there is control over strategic sectors. The policy framework is still evolving. See, we have started this some with from 2010 to 2022. So over a period of more than a decade, the policy framework is liberalized and encouraging, and now it is still evolving. However, the direction is very positive. India is increasing its is becoming an outward investor, and with this rising overseas investments and stronger domestic capital formation, India is becoming an investor and reducing its dependence on foreign capital and asserting itself as a confident contributor to the global economy. This is what we find in the Indian investments abroad. So, any questions?
Yes, sir. We'll get into the questions. Much, sir. I am really grateful to CA Shiva Prasad, sir, and to CA Bhargava Naidu, sir, for such a detailed presentation and such an informative session. Thank you very much. Now going towards the questions, in the question chat box, the question answer, we have
Yeah, we have one question, I think, in chat
if
box.
a company has positive reserve surplus and is only having a CC account for its operation, where the collection are credited OPEX, it's incurred. expenses
This-
incurred. Can they
Okay,
use funds from CC account for investing? This is by Mr. Ravindra Pai, if you get that question.
Yeah, I can answer this. CC account is always is a cash credit account. It is meant for the purpose of working capital. So you cannot, even if there is money in it, even if there is a positive balance, you really can't invest abroad, because it is a banker's right to restrict your or allow. So by right, you cannot invest, because cash credit is only meant for the day-to-day business operations and not for investment. It is, and especially it is not a capital account transaction, it is a revenue account transaction.
Right, sir. So next question, if the reporting is not done, say by 1.5 year, then can such reporting be done
Pardon?
after 1.5 year with late fees? Next
Yes.
question, sir. By Akshita.
The late fees can be paid, and any such delays. In fact, we have already explained it is up to 3 years. You can use that facility.
Right. So she's saying, if yes, will there be requirement to submit 3 ODI forms for the 0.5 year, half year each, or only one for the period when ODI was made?
I think the bank may be in a position to advise this. See, in my view, it can be done in one form also.
Right. And another question, there's a compliment by a member, fantastic web. So thank you for the detailed presentation. So another question is, when return individual keep his investment abroad after having Indian resident status, any issue? Sir, can you explain the difference between ODI and OPI?
ODI and OPI. ODI is a direct investment when there is an issue, and OPI is an investment in the market. So you can acquire anything in the market that is called OPI, that is portfolio investment. Anything which is
Right,
not
sir.
portfolio investment is a direct investment.
Right, sir. The above question, when return individual keep his investment abroad after having resident status, any issue? I don't
No,
know this
he
question.
can keep. That's why we said that he can
Okay.
open a foreign currency account, even for further investments. So in case it is an Indian investment and it is invested on a repatriation basis, it has to be repatriated. Even dividends have to be repatriated.
Okay, sir. The next question is, can an Indian resident individual make ODI through Indian trust in UK company?
No, a trust can only invest in another trust with the similar
Okay,
objects.
sir.
That's what we have already explained. Societies and trusts can invest, but they can do it only with the similar objects, another trust.
Right, sir. Question is, filing / reporting requirements for step down subsidiary of a listed company.
Can you please repeat again?
Yeah, filings / report requirements for step down subsidiary of a listed company. I don't know if this question is clear, or
No,
maybe
so
the question is
see,
not complete.
any listed company can always have a subsidiary as well as a step down subsidiary. A step down subsidiary is again registered abroad in the host country,
Right.
and the subsidiary is going to invest in the step down subsidiary. The foreign subsidiary is going to invest in the step down subsidiary. So in case any requirement is there as per the host country's law, it has to be done.
Right, sir. Can you please explain repatriation? The question that one of the members
Repatriation, in case any investment that is made on the repatriable basis.
Okay.
That means after some time you
Right,
have
sir.
to, so if it is a repatriable basis, then it has to be repatriated. If it is a non-repatriable basis, it has to be it need not be repatriated. Yeah.
Right, sir. I think we have finished all the questions, and we have completed the questions which were there in the Q&A box. So, just for the information of members, we'll be sharing the PPT along with the details of our speakers for your information, and we'll be sharing the recording of the session also. So it's my privilege to conclude
May I
the
thank?
session, the vote of thanks.